The Dow just hit 50,000 for the first time ever, and Asia is rallying. But here's the twist. This is happening while the US economy shows cracks and China fights deflation. This is Kenya News Update today. Coming up, you'll discover why global markets are ignoring the warning signs and what this means for your investments. Meet the global investor, watching screens from Nairobi to New York. On one side, a record-breaking stock market. On the other, flat consumer spending and weak inflation data. But here's what nobody's talking about. The rally is continuing anyway, and the reason will blow your mind. For 9 years, we've been in a bull market fueled by tech and cheap money, but something changed this week. The US December retail sales report was a dud. Consumer spending was flat, 0.0% growth. That missed the expected 0.4% monthly gain, a clear sign the American shopper is tapped out. Yet the Dow Jones Industrial Average didn't just survive, it thrived. It rose 0.1% to a closing record of 50,188.14. That's its third consecutive intraday record. But here's the part that will shock you. The broader market didn't celebrate. The S&P 500 lost 0.33%. The Nasdaq Composite slipped 0.59%. Why? Artificial intelligence fears are taking hold on Wall Street. The very engine of growth is now sparking panic, so the story splits. In America, a tale of two markets, a blue chip record and a tech sell-off. Now let's fly to Asia. While the US frets, Asia-Pacific markets traded mostly higher Wednesday. They're continuing their rally, but they're doing it while assessing China's latest economic data. And the data is weak. China's consumer price index rose just 0.2% in January from a year earlier. That's below the 0.4% increase economists forecast. It's a sign of continued deflationary pressure. The world's second-largest economy can't get prices to rise meaningfully, even without stronger stimulus. So why is Asia rising? Let's break it down. Australia's S&P/ASX 200 was up a huge 1.43%. South Korea's Kospi rose 0.6%, on pace for a third day of gains. Hong Kong's Hang Seng Index added 0.13%. Only mainland China's CSI 300 lost 0.26%. Japan's markets were closed for a holiday. The contrast is staggering. Weak US data, weak China data, and yet green on the screens from Sydney to Seoul. Here's the revelation. Investors are shrugging it off. They're betting that weak data means central banks, including the US Federal Reserve under the Trump administration, will have to cut interest rates sooner. They're trading on hope, not reality. They're buying the rumor of stimulus, not the fact of strong growth. This creates a dangerous game, a market divorced from economic fundamentals, a high-wire act with no net. The implications are massive. If this rally is built on anticipation of rescue, what happens when the rescue is too slow? Or too small? Some say this is smart money front-running policy. Others say it's a bubble inflating on fumes. But the biggest unanswered question is this: how long can markets climb a wall of worry before the worry wins? We've seen this movie before. The music always stops. The twist today is that everyone knows the music is slowing, but they're dancing faster. For the Kenyan investor watching from home, this means volatility. Global markets are sending mixed signals and your portfolio is caught in the middle. Do you follow the Dow to new records? Or heed the warning of flat retail sales and AI panic? The system is sending you two messages at once. So, do you think this market rally is sustainable, or is it a bubble waiting to pop? Drop your take in the comments. Subscribe to Kenya News Update today for more breaking global financial news.